Have you ever wondered why mortgage rates actually go up and down, left and right, wherever they go? Or why your neighbor actually got a better rate than you? Well, most people think rates are kind of a mystery out there. But today I'm actually going to decode exactly how they work, why they change, and how you can actually take control of your mortgage journey. So let's jump in. I'm Stephen Brock, and this is the Brutally Honest Loan Officer channel, and I'm here to actually break down mortgage rates in a way that actually makes sense and is not very confusing. So if you ever asked yourself, why do rates change so freaking much? Well, where does that money for mortgages even actually come from? This video is actually for you. We'll talk about how rates are tied to mortgage-backed securities, how loan level pricing adjustments actually work, LLPAs come in, and even how lenders make money. By the end, you'll actually have the tools to actually understand mortgage rates and actually make a smarter financial decision in the future. So let's start by answering the big question. Where do mortgage rates actually come from? So mortgage rates don't just appear out of nowhere or the government picks it. They're actually tied to the bond market, specifically mortgage-backed securities, MBS. So let me break this down, step by step right here. Investors actually buy mortgage bonds. Imagine a pool of investors, big financial institutions who decide to invest in mortgage bonds instead of stocks or mutual funds. They take their money and they buy mortgage-backed securities from Fannie Mae, Freddie Mac, or Ginnie Mae. The jelly bean analogy, think of these bonds as jars of jelly beans. Each jelly bean actually represents a different type of loan. Red jelly beans, those are your high quality loans, 740 plus credit scores with a big down payment. Maybe those yellow jelly beans are actually your lower credit scores or smaller down payments. Investors prefer jars with more red beans because they are less risky, which impacts how much they're actually willing to pay and ultimately affects mortgage rates. So how are rates actually set? Well, investors tell Fannie and Freddie Mae, hey, we'll buy these bonds, but we want a 6% return on our money. Fannie and Freddie then lend that money to the banks with a small fee added, maybe 0.25. And so now the bank is paying 6.25. The banks in turn lend you, the consumer, at 6.5, adding their margin for servicing fees in there. Now mortgage rates are always moving. And here's why. The bond market moves daily. Rates are tied to the price of mortgage-backed security. When the bond prices go up, rates actually go down. And when bond prices go down, rates actually go up. So take a look at this. Each candlestick that you see on here represents a day of the bond market activity. Long candlesticks, that's a day with a lot of movement, meaning rates actually fluctuated significantly. Short candlestick, less movement, more stability. Now, rates change multiple times a day. Lenders reprice rates based on the bond market activity. So if you're actually shopping for a mortgage and actually comparing quotes, the time of day actually does matter. The rate you're offered at 9 a.m. might not be the same rate at 3 p.m. Now, let's talk about LLPAs, which are adjustments to your rate based on your loan details. And here's actually how you can find them. Go to Google, type in Fannie Mae LLPA. Click the link to the LLPA matrix and pull up that PDF. Focus on page 2. There's a lot of pages in there, but page 2 actually shows how credit scores and down payments and other factors impact your rate. For an example, if you have a 780 plus credit score and 25% down, you'll have a 0 rate adjustment. But if your credit score is 700 and you're putting 10% down, you'll see a higher adjustment on there, maybe 1%. This is why online rate quotes can be very, very misleading. Those best rates in the bold font, they're actually based on ideal scenarios like a 780 credit score and 20% down or more, not the actual rate most borrowers will actually qualify for. So let's clear up a common question. How do lenders actually make money on your mortgage? When you close on your loan, the lender typically transfers or sells your loan to a larger bank or servicing company. That company collects your payments, but the original lender earns a one-time fee for originating the loan. Even though your payments go to a different company, the original lender still bears some risk if the loan defaults within the first couple of years. So, to recap, mortgage rates actually come from the bond market and are influenced by investors' demand for actual mortgage-backed securities. Rates change daily and sometimes multiple times a day based on the market's activity. And loan level pricing adjustments, LLPAs, and lender fees impact your rate before you even actually see it. At the end of the day, my job is to actually help you navigate all of this. I know it can be complex, but my team and I run the numbers, shop the rates, and help you find the actual best mortgage strategy for your unique situation. Still have questions about how actual mortgage rates work or how to actually get the best deal? Drop them in the comments. Be happy to love to help you with that. And don't forget to subscribe for more brutally honest insights and check out my other videos to actually learn how to make smarter mortgage decisions in the future.